You've probably seen the headlines about 50-year mortgages, and a lot of people are trying to figure out whether this is something they should prepare for. So let's set the record straight. As of right now, there is no 50-year mortgage available to consumers at this moment. There's nothing lenders can offer, nothing you can lock, and nothing that exists inside standard mortgage programs today. But it is being discussed at the federal level, and anytime regulators start studying a change this big, it's worth understanding the potential impact, especially if you're planning a move. So let's break down what's real, what isn't, and what it would mean for you if the rules ever change. A lot of the confusion comes from not knowing how mortgage rules are actually written, so let's set the foundation. Right now, the CFPB's qualified mortgage rule is a rule that governs almost every mainstream mortgage on the market. It caps the loan terms at 30 years. That cap is built into the regulations, so Fannie Mae, Freddie Mac, FHA, and VA all follow the same limit. Because of that, a 50-year mortgage cannot exist unless several specific changes happen. So the CFPB has to change the QM rule, the housing agencies have to authorize a new 50-year term, automated underwriting systems are updated, and lenders have to adopt it into their loan programs. None of those steps have happened yet. No rule changes, no approvals, no implementation timeline. The only longer terms in the market are 40-year loan modifications, and those are strictly for hardship situations, not for new home purchases. So if you're buying a home today, the longest fixed rate term in the standard system is still 30 years. If the regulators eventually authorize a 50-year mortgage, here's the practical impact you would feel as a buyer. A lower monthly payment. So spreading the loan over more years lowers the payment. That's the appeal, but the final numbers depend on how lenders price the rate, because longer terms often come with higher rates, which can reduce the savings. So slower equity growth as well. So the early years of a very long loan terms are usually very heavily interest weighted. That means it takes longer to pay down principal, so you build equity much more slowly. Higher lifetime interest cost. So extending the mortgage by 20 more years increases total interest significantly. That's the trade-off behind the lower monthly payment. This doesn't make the idea good or bad, it simply makes it a different tool. So for some buyers, the payment flexibility might be worth it. For others, the higher long-term cost won't line up with their goals. So the right choice depends on how long you plan to stay in the home, your comfort level with long horizons, and whether you expect to refinance if future rates improve. Here's what matters today. There is no 50-year option available, and nothing in the current rulebook that allows lenders to offer these for new purchases. But the reason that this conversation started is housing affordability. It's a real problem. Prices have outpaced incomes in many markets, and supply just hasn't kept up. That's why regulators are exploring new ideas, even though nothing formal has been proposed. So if the rules ever change, I'll run a side-by-side number comparison for you so you can see the exact differences in payment, equity, and long-term cost with no guesswork. So until then, your best strategy is to focus on the tools that exist right now to improve affordability. That's like choosing the right loan type, using temporary buy-downs strategically, exploring down payment assistance, or even matching your payment plan to your long-term goals. So if you want help building a smart plan for your next move, book a call with me using the link below. And if you want accurate consumer-first updates, make sure you hit that subscribe button.